Hi, today is Saturday, September 2nd, 2023, and I am Jason Shapiro with crowdedmarketreport.com. Today I was going to talk about what I think is the biggest false narrative going on in the market right now, which is this idea about interest rates. And I know I've spoken about this before, but it's so out there right now that I just have to bring it up again. And the idea that people have is that, the Fed is almost done raising interest rates, and therefore interest rates are going to start to come down. And I just see this as the exact opposite of what will happen in terms of what interest rates will do. I don't know if the Fed's going to raise interest rates anymore or whatever. Interest rates are going to go up, not down. Well, how can that be? The Fed isn't raising rates. How do rates go up? Well, obviously the Fed controls short-term rates. And what's been going on is they've been raising the short-term rates. And as they have done that, the yield curve has inverted. So in other words, long-term rates have come down relative to short-term rates. And the reason for this, I believe, is because obviously as the Fed raises rates, the expectations of the future of inflation and the future of economic growth go down. So long-term rates, which are more about measuring the future expectations, go down. So to me, the opposite's going to happen when they stop raising rates. The people have to start believing that the future inflation chances are higher and the future economic growth rates are higher. So long-end rates actually go up, and you get the yield curve to uninvert and start to steepen, which means, again, long-term rates go up. And I think that's what people are just completely missing here, because I keep hearing it all the time. Well, rates are going to go down. Rates are going to go down. Well, I don't think they are. So what does that mean for us in terms of assets, and how does it line up positioning and sort of psychology-wise, at least from my reads? To me, it starts with obviously fixed income. If long rates are going up, then things like 30-year bonds and 10-year bonds are going to go down in price, and I think most people relate to it on a TLT basis. And I can tell you that people have been loving buying TLT, right? Because they're trying to anticipate the fact that rates are going to go down. And it has not been a very good plan, because TLT just keeps going down, right? And I know that people that are buying TLT, because quite frankly, I hear it every day from people. They're buying TLT here, they're buying TLT here, they're buying TLT here. They're just buying TLT consistently. So from a mass psychology point of view, that seems like the wrong trade to me. So think about some other assets like the dollar. If long rates in the U.S., in fact, are going to go up, and particularly relative to expectations, then the dollar is probably going to go up. And it's been kind of fascinating, because we've had the dollar going up since mid-July, right? It's the dollar chart. U.S. dollar index has gone up quite a bit since mid-July. It's a pretty big move for 6 weeks, right? But down here, people are massively short dollar, right? But as we have rallied, they haven't, this is speculators, this blue line, they haven't bought any. I mean, here's mid-July, right? They've actually sold into it, so that they haven't gotten out of their dollar shorts, which means that it probably can increase. This was the pound, where specs were massively long pound here at the bottom of the dollar, top of the pound. And they haven't really reduced any, a little bit, but not much. Same thing with euro, right? Here at the bottom, specs are massively long euro. The euro has gone down, and they really haven't reduced out of that very much. So to me, it seems like they need to get out of more of these euro longs and these pound longs, and therefore the dollar is going to keep going up, which makes sense if interest rates are going to, in fact, go up. And what does this mean for stocks? Well, one would think if rates were going to go higher, that would arguably be negative for stocks. I'm not seeing anything in the positioning right now that is saying that. It's really kind of more neutral across the board here. Like they're leaning a little long NASDAQ, a little short Dow, you can see, right? They're leaning short Russell, and they're leaning a little short S&P, but it's more neutral than anything else, which means there's nothing really there, is what that tells us, positioning-wise. But I could make the argument, sure, that equities are going to go down should rates go higher, but it just kind of feels to me, and look, this could be wrong. Anything I say here could obviously be wrong. This is just my feeling based on my history of looking at this data and watching markets move as this data moves. and as the psychology moves. It still feels to me at the end of the day like people are too bearish stocks. They're starting to give up on it, but I think they have a ways to go here. We are switching from, in my view, and I've spoken about this way earlier at the very beginning of the year, but they're finally doing it where they're switching from this belief of a recession's coming and now slowly switching to, well, maybe a recession isn't coming, right? There's an argument there that they might have to get long stocks into that, get out of these shorts that they've been stubbornly sitting on, waiting for this recession, give up on the recession idea, and get back to getting long stocks. And if that happens, I would expect that the stock market is going to have one last move back up until they finally realize, like, oh my God, we just bought everything right as rates were going up. And that's what's actually going to slow down the economy. And that's what's actually going to bring on this recession. And that is what eventually will bring the stock market down. But shorting the stock market of all these trades is my least favorite trade. I'd much rather be short things like 10 years or 30 years, a long dollar, or short euro, short whatever, and wait on the stock market trade. I know shorting the stock market is the sexiest trade in the world. I also know it's the least profitable trade over time in the world. And also it's really not positioned for the risk reward to be there. So that's kind of how I see things going forward here, which is part of the puzzle that kind of started in the beginning of the year when the idea was, hey, recession was going to come, and so let's fade that. And you don't want to be too early, right, for the other side of it, because there could be this adjustment in the stock market in particular. So let it adjust, let everybody panic in, and then maybe we can talk about shorting the stock market. But in the meantime, I think the best way to be short the stock market or to play this trade is short TLT, short long bonds, and continue to be long the dollar until people buy into all this stuff. Okay? So that's the idea for today. I hope it helps. I'm always happy to hear questions and comments, and we hope to see you on crowdedmarketreport.com. All right, thank you, and I hope everybody has a profitable week. Thanks.